You might be on mute. Let me try to unmute you.
Okay, sorry.
Okay, now we can hear you.
Okay, so presenting our paper, Boosting Over Deep Learning for Earnings. My name is Stephen Choi. My co-authors are Xinyue Choi and Professor Jingran Zhao. Xinyue was a research associate at LoRa Technologies as well as student of Professor Zhao at Hong Kong Polytechnic University. Just a quick thing about LoRa Tech. We started in 2019 in Hong Kong. We started our research joint venture with HK PolyU in 2019, and we were doing a bunch of projects, of which Xinyue was one of the researchers, and we've participated in the startup circuits, and we will be in Cyberport, Hong Kong, starting next month. So the motivation for this was we wanted to use AI techniques to forecast earnings. Basically create a synthetic AI-driven research analyst. Previously, that project that I said we started in 2019, we were able to use LightGBM and XGBoost, gradient boosting trees to some success, and we wanted to continue that. And we actually had already used deep learning combination of CNN and RNN for technical analysis, and we wanted to replicate something similar for fundamental analysis. So, we've actually published a paper based on some of our deep learning models for technical analysis 2 years ago. So the constraints for fundamental analysis is just like anything else in finance, it's very noisy. The other bigger constraint is that it doesn't have enough data. With prices, you can go to ticks, you can go to days. Even if you go to days, you have 250 samples per year. With quarterly data, you've got 4 per year. So the data sample noise combined basically creates a high dimension, low sample size HDLSS problem. So when we basically the problem is we take stocks. We took about 950 stocks among the S&P 500, Nikkei, CSI 300, Hang Seng Composite that actually gave this data. Some companies did not give enough data of financials. So we took about 22 financials for using WorldScope for the fundamental data. We took IBES, basically analyst consensus estimates. We took 16 macroeconomic data ratios and stock price data to create our input data set. So using the fundamental data, we came out with roughly 22 ratios. And for some of the more important data sets, we used CAGR of 1 year, 3 year, 5 year, but non-overlapping. So it would be from 1 year past to current year, 3 year past to 1 year past, 5 year past to 3 year past. So using non-overlapping compound returns for important data such as net income, net sales, cash flow. So a lot of these things are usually very well widely used for research analysts on sell side institutional banks. This is something that pretty much is at least um, in all the research papers. It's in all of the normal stock information when you go look for it. the macro data is stuff that we've kind of trimmed down to the ones that we've used in previous quantitative studies. So we use an AI model to basically forecast a 12-month EPS. It's not exactly EPS. We're doing a change in net income divided by market cap, but it's the same numbers. And we're doing a YOY, so it's we're looking for change in the EPS for 12 months to the next 12 months. And the test sets, we didn't do any time splits. The way that we split the data was we split it train, validation, and test across stocks. So when we were using this data, we were going over 20 years of data from 1998 to 2019. So when we use the data set, we randomly split into 5 sets of stocks, and we would train and validate on the first 4 and do an 80-20 split on the train and validation of the first 4. And then we would test in the 5th set. And then we'd roll down, test on the first set, test on the second set, test on the third set, test on the fourth set, so that you have 5 different iterations, independent iterations of the model. And when we consider results, we use the median MAE test results as the results to compare against. And we did multiple configurations of these tests. The first configuration is we would use a smaller sample. The set is already very small, but we wanted to show what happens if it goes even smaller. We used the entire sample in the second configuration. In the third configuration, we basically partitioned, we actually created the tests for each industry group. So we would do this partition just for the auto sector. We would do a model just for the banking sector and one for just the technology sector, which is basically what happens at a research analyst team at a bank or a research boutique. You have analysts covering an industry as opposed to just, the whole universe. And the fourth configuration, we added the IBES consensus estimates into the input for the model. And for all these configurations, it's the same 12-month forward earnings that we're trying to forecast. So when we use light GBM or XGBoost, basically using gradient boosting trees, the results are obviously it gets better with more data. And when we do the industry partitions, even though the sample sizes get smaller for each model, the results do get better. So instead of putting everything into one model, if you only put the auto stocks into one sector or the technology stocks into one model, it actually does better. There's obviously a limit to this. If your sample sizes get too small, there's not enough information for any kind of machine learning model to use to learn. So it's not exactly very, very small sectors as opposed to kind of super sectors or larger sectors that had at least a minimum amount of 30 to 40 stocks. So the industry partitions, when we used the super sector partitions, it actually improved performance with drastic increase in R squared. And when we use the IBS consensus estimates, we started actually really beating the research analysts, the experts. So when we use the experts data in, it was able to recognize that this information is quality information, and given the input data that it had and combining it with the consensus data, it wind up having very, very strong results. Configuration 5 is instead of light GBM as in configuration 1, 2, 3, and 4, 5, we're using XGBoost, another similar type of model, and the results are fairly similar. Now, this isn't a machine learning or AI model, but when we were looking at a recent paper of how this model also uses public information as well as using consensus data, they came up with a result. They're using a MABER, a median absolute error ratio, and our configuration 4, a light GBM model using the input data mentioned above, as well as the IBS consensus data, we were able to beat this MIDAS-based model, a fairly recent model. So we're pretty happy with these results, and we wanted to see what happens if we start using more powerful models. What happens if we start using deep learning? So when we started going into these deep learning models, you can obviously see that when it's not enough data, it performs very poorly. When we have when we have more data, it improves. But actually, this configuration B is just half the nodes. Just we have a lot of the hyperparameter sets to things that are very small. So we basically cut down the tree, fully connected model into half, and that made the results better. When we did industry partitions, it no matter how big of a sector you get, it just doesn't help. The deterioration in performance from having a smaller data sample set completely cuts into any kind of performance. And when we start using the IBS consensus, it doesn't really help either. It's almost as if it can't even recognize that the consensus estimate data is good information. So so in configuration 5, what we did was we actually got some help from the gradient boosting trees. So we came up with the top 15 information that was the most used in these trees. And when this is the most important information, and we input those, then we started getting a noticeable jump. So when we actually have the trees, the input data saying this is the important parts based on what we came with in gradient boosting trees, then we were able to see a significant jump in performance. And finally, because these are just fully connected networks, it really didn't put into the time series aspect of this. So what we did was we actually inputted a RNN, a GRU model. So we were putting in separate GRUs for each one of these 15 inputs. And at the end of it, we were combining it with a fully connected network to come up with the earnings prediction. Couple of things that were interesting here was that instead of putting these models together, it was actually you needed to separate it as if it was trying to decode all this information. So using this kind of fully connected at the end of a GRU model that is thinking of all of these inputs in a time series came to a R square that was actually quite comparable. But the problem is that running running the light GBM model, for example, takes about 4 or 5 minutes on a i7 PC. running this RNN, RNNs being as long as it takes 4 minutes per epoch on a RTX 2080. I mean, there are more powerful ones, but it's still fairly powerful, and it would take 4 minutes per epoch. This is not multiples, but exponentially would take much longer to run to get something that actually performs slightly worse. So our problem was that it was taking a little. We found that deep learning actually is not very useful in this kind of model, and it's not useful because this is a high dimension and low sample size um, problem set. The inputs are not are very heterogeneous. You're talking about capex that might be quarterly, GDP that's announced quarterly, but actually reflective of a month prior. That's also gets adjusted. Price is a daily factor, and a lot of these things are not always in the same frequency. And trying to match it up into the same X prior information doesn't really necessarily mean that they are lining up in terms of the time series. And we didn't put this in the paper, but our kind of colloquial thinking is that CEOs and managers don't really think like a neural network. They kind of think more like a decision tree, and they say, okay, this industry is doing well, so we got to go for higher revenues. We got to spend lower, and now the stock returns are too low. We have to try to boost the net income so that it's
Sorry to cut you off, Stephen. We're a bit over time, so if you could wrap it up over the next minute.
this is my last minute, so that the CEOs probably do make decisions very closer to a decision tree, even though economies obviously work in a very noisy fashion. That the company and the managers that run these companies might be in a decision tree. That's why trying to model their earnings might be better with decision trees. So thank you.